We've got Scott Martin with us, Kingsview Asset Management. We've got Dan Geltrude, Geltrude & Company founder. Dan, that was me making the leap on his acknowledging right now that disorderly market moves would be a concern, but that he might not concern himself with addressing it right away. Does that worry you? And is that a good posture to take?
I actually think it's a good posture, Neil, because I think Jerome Powell actually needs to step back a little bit here and not over-involve himself with the way things are going. Ultimately, this is going to work itself through, primarily driven by what happens with the vaccines, because as the vaccines get into the arms, and we're going to unleash this economy and get back to hopefully what was a pre-pandemic economy, things will work themselves through. So I think Jerome Powell is taking the right position by actually sitting back and waiting right now.
Dan, the basic backdrop for all of this is an improving economy. Things are looking good. A lot of companies are talking about optimism for robust sales this year. Some of the big chain stores and big box retailers and Target and Walmart, a host of others, very, very optimistic about how things look for the rest of the year. Kohl's, the latest among them. We're seeing big plant and equipment expenditures on the part of very big players. United Airlines buying 25 of these 737 MAX planes. You don't do that unless you're optimistic of a turnaround, certainly in travel post the pandemic. So the backdrop is good news, right? I mean, or is this something more, involved that I'm missing?
No, it is good news, which now begs the question, Neil, do we need 1.9 trillion of stimulus? And the answer is very clear. We do not. We need to certainly help some people and certain sectors, no question. But that much stimulus we don't need. And Jamie Dimon was actually talking about this earlier this week related to this is too much stimulus because the economy, once we get those shots out, is going to take off. And that's why we have a reasonably good chance of going into an inflationary period, because the one marker that's missing for us to really be at that point is getting unemployment down. And that is going to happen once people are vaccinated and getting back to work. So I think the market has to be very careful about what they wish for. They seem to be very pro-stimulus, but in the end, that may not be a good thing for them.
Dan, when I look at it, a trend, I hate to say trend because sometimes 3 or 4 days counts as a trend, and I don't want to overstate it. We start out okay in the morning. Futures activity look okay in the morning. And then it's, tumble city as the day ensues. And the catalyst, certainly, I'm not minimizing the comments, out of Jerome Powell and how he might have fed the beast here. But it is a pattern. What do you make of that?
Well, what I think, Neil, is to Scott's point related to there's emotion sometimes here. And I think when it comes to investing, mixing an emotion is not a good thing. And people have a tendency to be overly emotional when it comes to the market starting a slide. And then you see the sell-off, and then you start looking at those bond rates, and you say, all right, maybe it's time to diversify and make the jump now. And of course, you can't do that. You have to stick with your long-term strategy, because as you move away from that, you start to make decisions that are not based on the fundamentals. And that's what starts to happen with the market. That's what we're seeing today.
Scott, the only difference, this is where I'll politely diverge from Dan, from my great respect, is that this is the first time that, where the yield on a 10-year note is north of the yield on the S&P 500. When we've had these prior, dips and stocks have come back, that was not the case. Now, that might not be a huge distinction, but a distinction nonetheless. Does it trouble you if it maintains, or this gap, in fact, widens between a 10-year note yield and that of the S&P 500?
No, because I think that's another opportunity where you just have to look. And I agree with everything Dan said. I gave him a little golf clap there instead of speaking over him, because you have to realize that those are opportunities. I mean, when spreads blow out, when those diversions get so wide, they eventually revert to the mean. And so we did live in a period when things were so favorable for equities, as I talked about in the last segment, Neil. I mean, other than, say, March and April of last year, it was a pretty darn easy investing year. I mean, it's incredible to think about.
Yeah.
And so now we're in this period where we're transitioning. And I'll tell you one other thing that I think Dan touched on just a bit ago. We have printed so much money and we have so much stimulus out there and we have an infrastructure spend that's coming down the line. That's what I think is really pushing up interest rates. We have all these bonds out there that have just flooded the market. And when you increase supply, price goes down. And so there has to be an adjustment to that fact.
Boy, you guys are as thick as thieves, right? God forbid someone tries to say something different, you know.
He told me to say all that stuff. I'm just following the script.
Yeah, I understand.
Well,
that.
Neil, if you're going to
Dan,
disagree with me, you got to be right.
3%. You're right. But if you're over 3% now for mortgage rates, very, very low, I grant you. But as an accountant, Dan, you know, sometimes numbers, when they hit a round level, they prompt a change of behavior. Actually, it might propel more mortgage activity and home buying and all that. How do you think this sorts out?
I don't think where the mortgage rates have moved so far is going to have any impact of any significance right now. However, if the mortgage rates do continue to rise, you may see some cooling off on the price of real estate. I mean, that's just the natural trend. As rates come down, real estate gets more expensive for the buyer, and you have the reverse happen when it goes the other way.
All right, well said. And I'll regale you guys on when I got my first mortgage. I don't know if I told you guys, and it was a lot higher.